everyone. My name is Linda. So I'm based in Singapore, and I lead CRU's battery materials research in Asia Pacific. So I have tweaked the title a little bit, and you can see the first word I put here is reviewing the reality, because there's drastic shift of the landscape across the value chain. And I guess the battery metal is slightly different from other conventional commodities because it's not only determined by the supply and immediate demand, but also drastically changed by the end consumers, such as the landscape and development of the electric vehicles as well as energy storage. So the next 20 minutes, I would like to start with encapsulating what is happening across the value chain and also translate to you what that means for the commodity. So if I can use three phrases to encapsulate what is the key challenges that the entire value chain are facing at this moment, the first one I would use is the slower than anticipate EV uptake. The second is a profitability challenge as a result of intensifying competition. Lastly, I would address that it's rising protectionism. And I'll explain more into details in later slides. So I would like to begin by affirming our long-term perspective. So the shifting towards the energy transition is instrumental to our environmental objectives. Looking ahead, the transition towards electric vehicles is expected to persist and gain momentum, supported by the investment from the industry leaders as well as government support. And beyond powering vehicles, high voltage batteries also plays a critical role in stationary energy storage, essential for expansion of renewable energy infrastructures. And this is particularly crucial for the solar industry, which demands reliable storage solutions for a period where the sun is not shining. Over the next 12 years, we anticipate a 7-fold increase in battery demand. However, in the near term, there is a clear disconnection that is manifesting. So often this is referred to as so-called EV chasm. So this term is coined by the South Korean manufacturers, highlights a temporary market slowdown due to stock overhang and the reduced consumer uptakes, especially in market in EU and US. Now, in this challenging environment, legacy Western OEMs are grappling with rising financial pressures and increasing competition. Even though the prices of key battery components are at a low level, these manufacturers are struggling to be cost-effective and profitable with their EV offerings. And this slowdown is not only stopped in the OEMs, it significantly impacts the profitability of the major battery manufacturers. Leading South Korean and Japanese battery manufacturers, having heavily invested in supplying the legacy Western OEMs, are now also facing the slowing order books. And this is illustrated in the middle chart, where the policy support like the US AMPC tax credit is proving essential, serving as a lifeline for their domestic manufacturers to counterbalance the operating losses. Moreover, the rippling effect extends beyond the battery manufacturers to their broader supply chains, including the cathode producers. As indicated in the production capacity plans in the right-hand side, so this is from the Q2 earnings they released. Many of the South Korean cathode producers are revising down the sales forecast, as well as scaling back investment plans due to these market conditions. Now, as a result of this EV chasm, many manufacturers are currently facing significant profitability challenge. Now, here are three key takeaways from our battery value chain services. First of all, be looking at the left-hand side. Generally, maintaining the miners are maintaining the highest profit margins, especially for those with ore to refinery integrated operations. Although, if you take a closer look, lithium, cobalt, and nickel top producers, they're also showing the orange and red colors, indicating a year-on-year decline. There's also growing divergence in profitability as raw material prices reach the break-even point for the marginal producers. Now, turning into the midstream producers, which is precursor and cathode manufacturers. These are those producers not benefiting from the vertical integrations are experiencing the most acute margin pressures. As demand slows, PCAM and cathode producers are losing market share and are reduced to a tolling role, where they merely process the materials on behalf of battery manufacturers without benefiting from the end product markups. Lastly, contrary to other segments of the supply chain, if you're looking at the right-hand side, the battery manufacturers have managed to capitalize during the period of declining raw material prices. They are effectively setting the margins within the industry, dedicating term to their suppliers. To enhance the profitabilities, OEMs can either increase sales price or cut cost. Given the current market slowdown, raising price is challenging, prompting a focus on cost reduction. Notably, the Western legacy OEMs have realized that their historical emphasis on high-end nickel-rich battery segment has neglected the mass market affordable segment, which is now gaining renewed interest due to declining consumer affordability. Here is a strategic roadmap that we compiled for both OEM, cell manufacturers, as well as cathode manufacturers. As you can see that many are diversifying to include low-cost technologies like lithium iron phosphate, which is showing on the light blue color here. In contrast, the top-tier Chinese OEMs such as BYD have long focused on this affordable segment, achieving significant cost reductions through the continuous innovation. From the right-hand side chart, you can see that the cathode producers in South Korea and Japan have all included iron-based chemistries in order to fulfill the Western OEM's ambition to tap into this affordable sector. Now, Chinese OEMs are also pursuing underserved entry-level market beyond their homeland. Their strategy is clear: replicate their domestic success by leveraging their cost competitiveness to quickly capture this overseas market. Now, there are several factors are propelling this expansion. Domestically, the Chinese market is becoming saturated, and direct consumer subsidies has been scaled back. Economic pressures have also led the consumers to tighten their belt, limiting their spending power. Crucially, selling abroad allows Chinese OEMs to command a much higher price. It is also important to highlight that this overseas push extends beyond just vehicles. Battery and component producers are also seeking international growth opportunities. As reflected on the right-hand side in the gross profit margin of leading Chinese battery and cathode producers, the overseas market offers significant higher profitability. Strategically, it makes sense for these companies to expand abroad, capitalizing on more lucrative market to boost their global presence and profitability. Chinese battery producers are widely recognized for their formidable advantage in cost, scale, and technology. An analysis from our CRU's battery cost model using a NMC 811 battery as an example on the left-hand side shows that the Chinese manufacturers have a substantially lower processing cost compared to other regions. The advantage is also compounded by lower labor cost, a well-known factor, and their ability to secure raw materials at cheaper rates than their global counterparts. Additionally, the Chinese battery industry is currently experiencing overcapacity. This environment of intense competition within China means that only the most cost-efficient and innovative producers can sustain their operation and expand overseas. A key factor behind the cost competitiveness of the Chinese OEMs lies in their strategic move towards vertical integration, a concept embraced by the Chinese entities well before it became a phenomenon in the Western world. To provide a clearer understanding, let's take a look at this chart from our battery value chain services. Unlike traditional methods that track production by the physical location, we offer insight based on the equity ownership. The dark red color here represents the Chinese-owned production facilities within China. While it might appear that China does not inherently possess abundant mineral resources like nickel and cobalt, the scenario shifts dramatically when including assets owned by the Chinese companies abroad. Another thing to note is that the Chinese firm have a dominating presence in the refining of metals and chemical processing of cathode and anode materials. This strategic foresight in vertical integration allows a Chinese company not only to secure a significant portion of the supply chain, but also minimize the premium on materials and processing along the value chain, thereby enhancing their competitive advantage in the global market. The swift overseas expansion of the Chinese companies has sparked concern among Western policymakers, prompting the implementation of strategic measures to protect domestic supply chain. In response, Western governments are deploying a mix of protectionist and incentivizing policies in order to safeguard their industry. It is important to know that the fundamental difference between the stance of the US and EU is that there's a clear intention of decouple from China, particularly from the US regulators. So now focus on the US from the left-hand side. Recent developments have seen that the finalization of additional Section 301 tariffs targeting a range of the Chinese products, including EVs and lithium-ion batteries. While the impact on the EV is largely symbolic, given the relatively low volume of the Chinese vehicle export to the US, which total only about 10,000 vehicles in 2023, the real impact is felt in the battery sectors. In theory, these tariffs should protect US battery producers from Chinese competition, particularly when combined with the $40 per kilowatt hour IRA manufacturer tax credit. However, this does not necessarily lead to lower cost for OEMs. Prior to the implementation of the 301 tariffs, the US has already imposed a 25% duty on the key battery components, such as cathode and also critical minerals like lithium carbonate, hydroxide, and nickel sulfate. So these pre-existing duties have already compromised the cost effectiveness of the US battery producers. Moreover, as demonstrated in earlier slides, leading battery manufacturers are experiencing significant profit margin pressures, which may incentivize them to retain the benefits of the tax credit rather than passing on to the OEMs, which means the retail prices of the battery may still remain unchanged, and the tariff may have offered little help to improve consumers' profitability or alleviate the manufacturer's existing profitability challenge. On the right-hand side, the EU's recent hike in provisional anti-subsidy duties on the import of battery electric vehicles as well as extended range electric vehicles from China is more impactful, with tariff rising up to 46% depending on the manufacturer. This significantly affects the EV trade flow, as Europe is a key export destination for the Chinese BEVs. However, replacing the Chinese EVs presents a considerable challenge in Europe, primarily because that these vehicles typically target the most affordable market segment. As we have explained in the earlier slides, this is a niche not being served by the local European manufacturers. Therefore, the increase in tariff is more likely to undermine consumer affordability and negatively impact the overall EV adoption rates across Europe in the near term. Besides, Western policymakers are also offering incentives to boost EV adoption, with the US IRA being the most structured and well-funded initiative. However, claiming the $7,500 tax credit under the 30D involves stringent compliance with raw materials and battery component sourcing requirements. Crucially, any vehicles incorporating materials or components from a foreign entity of concern immediately become ineligible for the tax credit. But when we look across the battery supply chain and assess the risk profile based on each operation and project's geographic location and equity ownership, what we have observed is the compliance sources marked in the dark blue color at the bottom represents an alarming small volume. It is important to note that even among these compliant materials, many are tied up in the long-term agreement with the Chinese manufacturers, and simply not available in the open market. In stark contrast, the non-compliant sources, due to FEOC status, shown in the dark red on top, constitute a much larger proportion of the supply chain. Additionally, a significant amount of mining occurs in non-FTA countries, like nickel operations in Indonesia, indicated by the light red color here. So what we are trying to show here is that the battery supply chain is complex, intertwined, and heavily interdependent between each region. The idea of decoupling China and the effort to minimize the Chinese participation is not only challenging, but also would entail significant cost. So what does that mean for the commodities? Over the past 2 years, we have observed a significant decline in prices of the key battery metals, driven by supply growth that has outpaced the demand, keeping prices low due to rising stocks throughout the supply chain. Let's focus on lithium first. Current market conditions have compelled producers to optimize operations and delay non-essential capital investments. According to our lithium asset service database, Australia remains the most cost competitive, with a value-adjusted cash cost of around 400 to 600 dry metric tons in 2024. Conversely, Zimbabwe mines, positions at the middle to higher end of the cost curve, have an average cost of about $770. Chinese producers, with an average cost at above 1,100 per ton, particularly those with high-cost lepidolite mines, marked by lower grades and low recovery rates, face a significant risk of closure due to the economic and environmental pressures. Looking ahead of 2025, falling prices are expected to trigger a wave of curtailment in mining and refining, potentially removing approximately 100,000 tons of supply from the market and leading to a drawdown of inventories. By late 2027, we anticipate a decline in global lithium inventories, with production expected to fall short of demand in 2029. As for nickel, Indonesia remains the largest contributor for supply growth, and we expect a sustained surplus for over the next few years. Specifically, we expect Indonesian MHP production to double in 2 years and more than triple in 2027 as new projects come online. As illustrated by our cost curve here, globally, the IRA-compliant nickel supplies are not only limited in scale, but also high cost. In contrast, Indonesian HPAL operations are among the most cost-efficient, ranking in the first and second percentiles. Currently, there are 3 main barriers that hinder Indonesian nickel from fully embraced by the Western OEMs. Firstly, Indonesia is not a FTA country, potentially causing OEMs to forego at least half of the $500 tax credit. However, this doesn't necessarily deter OEMs from utilizing Indonesian nickel, as the cost savings from using affordable Indonesian source may offset the loss from the tax credit. Secondly, the extensive Chinese ownership and involvement in the Indonesian projects are scrutinized by the US regulators, risking classification as FEOC, immediately disqualifying the OEMs from claiming their tax credit if using the Indonesian sourced nickel. Lastly, environmental concern, particularly around the tailing management, persist despite Indonesian HPAL operation emit only around 8 to 10 tons of CO2 per ton nickel produced. Despite these challenges, investment in Indonesia continue unabated, driven by rising uncertainty and geopolitical tensions, as manufacturers seek cost reductions and further vertical integration. Lastly, I would like to stress again the importance of adopting a supply chain perspective when considering investing in the battery metals. A significant bottleneck here is the processing capacity. While China may lack certain raw materials, it dominates the processing sector. Western producers, despite securing critical minerals, often lack such capabilities. So why is the West lagging in developing processing capabilities? The answer is largely lied in profit margin and operational barriers. As you have seen in our early slides of the profitability analysis, margins are primarily sitting at the mining stage, even within the high cost-efficient Chinese firms. Processing is generally with far less profitable. Entering this sector requires substantial capital expenditure, advanced technical know-how, and a skilled workforce. Moreover, strict environmental regulation further complicates the establishment of refineries due to their potential environmental impacts. Even Chinese firms are finding that replicating their success abroad involves more hurdles and risk than they have anticipated, and as a result, they have also slowed down investment overseas. To address these challenges and reduce dependence on Chinese processing, robust policy support would be crucial. This support should include financial incentive, regulatory streamlining, and also encourage the development of the recycling industry to ensure the regional supply chain. That's all for my presentations. Thank you so much.